Hey there, Justin Brennan here. I wanted to walk through this 268 unit apartment deal in San Antonio, Texas, Class B apartment, garden style deal, value add opportunity, and give you an idea of what we would do when we're analyzing a deal, when we're diving in deeper to a deal, just based on getting away from the surface stuff and diving in deep to see if it's actually something we would invest in and why. So let's walk through this one. This is the Oaks at Westlakes in San Antonio, Texas. So what we're looking for is we've gone into the Texas area currently and established both in Dallas, Fort Worth, San Antonio, and Austin in those three main corridors, setting up all the logistics, property management, construction firms, anything you can imagine, legal, accounting, blah, blah, blah. So that way, once we're going into a state and into a territory in an area, we have all the logistics and back office stuff set up. So it's everything flows nicely. That's the goal. So, but this is the idea going into Texas. The property sits nicely off Hunt Lane, and it's surrounded by a lot of commercial. You have expanding commercial areas, zones, good for development, good for growth, jobs, university systems, the middle schools, preschools, and elementaries nearby. So a good location. This is the summary video that gets onto our pitch decks, going through the table of contents of the property overview. So on average, we're looking at about an 18.56% internal rate of return on this deal, 8.44% cash on cash. And we'll go through these details. It's all on the financial metrics for you. The limited partnership is going to get 70%. So the investors are getting 70% of the deal. The general partnership is going to be getting 30% of the deal. And we're bringing in 10% of the equity, signing on all the loans and taking all the risk and getting 30% of the deal for that. Okay. The loan we're pulling down is about a $15 million loan based on a purchase price of $20 million, putting $5 million in down payment in. That loan is going to be a 5-year fixed loan, 2 years interest only during the rehab portion, about a 3.5% interest rate. Okay, and then we're planning to refinance it once we've rehabbed, re-rented, stabilized, refinance, and then continue to hold longer term for up to about a 5 to 7 year period. Cap rates purchasing around a 7%, overall debt coverage ratio around 2, and then closing costs $750,000. And then we have about $2.5 million anticipated for the rehab portion of the project. So total equity needed about $8.2 million in total equity. Property stats, 268 units. Current rents are averaging around $795 for the ones, $1,000 for the twos. 95% occupancy, which is good. Buying right around a 7%. 1984 building, and household income for that area is around $56,000 a door. About the property, this is the unit mix. Not ideal, but the one bedrooms in this area actually do quite well, which is why they went into a higher mix of 70% of them and 30% for the 2 bedrooms. There is laundry on site, parking on site through carports, facilities, pool, spa, fitness, storage, picnic areas, barbecues, and more. Here's some of the property photos. Some more photos. You got the bedrooms in here, the unit counts for the ones, and then the 2 bedroom units. Some before and after shots. So right here, we're showing kind of what the initial units currently look like. Classic units versus the potential upgraded scenario for these classic units in 2 stages. You can do a partial. We don't want to do that. We want to go full blow and add a full premium of $150 to $200 per unit per month in the premium by doing stainless steel appliances, solid surface, whether that's a quartz top, backsplashes, upgrading the plumbing fixtures, modern lighting, new cabinetry, putting in kind of the LVP vinyl flooring, adding the additional blinds, potentially washer and dryer hookups in the units. Some have them, some don't. And then doing some wardrobe mirrors and mirrors for the bathrooms and stuff like that to give it a nice good feel to where it's going to kind of look like this over here, right? Kitchen, you got that kitchen, this kitchen, and then these baths back and forth to kind of give you the before and after on what we would do with this complex. Rent comps, I'll leave these in the financials so you can go through those in detail. The business plan strategy, as I mentioned in the beginning, we plan to remodel 200 units with the flooring, kitchens, baths, paint, and then 68 of the units with kind of a light remodel. Estimated cost per unit between $5,500 to $10,000 a unit in expenses. And then we're going to stabilize it. We plan to refinance the property with about 60 to 70% debt, okay? And that's going to be right around years 2 and 3. We'll recapitalize back to investors about 60% of their capital back. That's the goal. And then continue to hold for a 5 to 7 year period, cash flow the property, and grow legacy wealth. That's the plan. Current timelines, November 10th, contract effective date, due diligence period through the end of December, Close date is into March of next year, 2021. Market overviews. I'll let you go through these in the financial pitch deck, but demographics, giving you kind of the radius, what's going on with San Antonio, Texas. Our investment gauges that we look at, from employment to rent growth to university systems. All the dynamics for both large employers as well as other tech firms, and then more importantly, university systems, retail and other commercials surrounding the property, and kind of what's happening with that job environment and population growth for the San Antonio, Texas area. Some of the vital signs: jobs, jobs, jobs. We always look at that. Business growth. It's an emerging market. It's, I think it's the number 6th or 7th largest city in the United States. So it's well beyond an emerging market. It's a thriving market. Vacancy rate's low, around 5%. Rent growth is good. And then the good fundamentals of jobs, university systems, well-rounded employment base. You can go through that for some of the neighborhood financials and stuff. Looking into the financials, and you'll get into detail in these in the pitch deck. Total cash investment, the mortgage on the property, total in about $23 million, and then the uses of the funds, right? $20 million for the purchase price, walking all the way down through the rehab, closing costs, and everything that we go through in acquiring the property. Some of the projections, this is kind of showing you over the term, if we're holding it 7, 8 years, we're coming in here year 1, boom, 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 and then we have the capital event once we rehab and restabilize, and then it's dropping back down to where you're having these slow growths in the cash flows and the internal rates of return. And these are some of the financial metrics. They're in your pitch deck. You can look at them. It's below this link on this video. People always want to ask, how much do you need? What's the minimum investment? When do you need it? When do I get paid? How do I get my money back? Good questions. So what we put together is a simple $50,000 investment example, and the projections on that for you specifically, if you would invest, say, $50,000 into this deal. You can look at this in detail in the financial projections and the pitch deck. Obviously, if you're an analytical person, you want numbers and spreadsheets. I got more spreadsheets than you can imagine. You can look at all of them, ask for more, the full analysis on all the properties, but this shows you the summary of cash flows along with the resale analysis. Current rent rolls of the property, breaking it down as to current versus pro forma, okay? Showing you some of the current rent roll metrics and cap rates, expenses, and NOI. The one thing that we didn't really enjoy right now that we're looking at is the expense ratios on the property currently. That's going to need to improve. It's right around 50, 53%. That needs to get down into like the low 40s. So we'll be looking at that. Unit mix matrix, as we showed earlier. And of course, the management team. At the end of the day, we use Verivest as our third-party investor relations firm. We have GYL as our accounting firm, and then bookkeeping as well. Everything's third-party based. I have multiple eyes on things as we're going through the process. Local property managers, local construction firms, everything is on the ground locally there. We use camera systems on everything, so we got eyeballs on everything all the time. All the investors get their own investor portal, which is nice. You can look in 24/7, see what's going on, get all your documents, your tax documents, whatever it is, see exactly where your investment's at and what it's doing in real time, 24/7, and have the confidence in that. And this just goes through kind of as the sponsor, as the general partner, what we get as a part of the deal. So you can see that in your pitch deck as well. All right, so now that we've analyzed the property, this was a draft example of a property we would be investing in, but we're not investing in this property. And I'm going to go through the reasons as to why, based on metrics that we look at in the very beginning all the way through it when we're analyzing it, okay? So first and foremost, we'd run it through the 1% rule that we do, which is, are the average monthly projected rents greater than 1% of the price per unit that we're buying it at? Now with this particular property, yes, it did pass that test, so we jumped in a little bit further. The average monthly projected rents, right, post-rehab is around $933 a month. Now 1% of the purchase price per unit is around $746. So that checks the box. We can move further into the analysis. Second one is it passed the 75% rule, whereby all-in cost, right, of $23 million is what we're anticipating for this deal. That number can't exceed 75% of our exit valuation once we're stabilized. That is ideally what we look for. Some people look for less than that. We go in, we'll max it out around 75%, depending on what kind of cash on cash, IRRs, and cap rates you're looking for. This does not pass that test. Right now, $23 million, that puts it right around 80, 85% of the exit stabilized value. That doesn't work, so big red flag on that one. Can we provide an 8% preferred return to our investors, a preferred return? The answer is yes, we can do that on this deal, so we look forward in that. The cash-on-cash returns, we want to see it in the low teens right around year 3, okay? Does it pass that test? In this case, yes and no, okay, yes and no. Now, we have a refi event that's a capital event, okay, which will then average out those cash-on-cash returns right around 11.75%, which is good, but when you look at that and you go through each year, it's really sitting in that kind of 7 to 8% range, even in the years 4, 5, 6 plus, which, you know, we like to see that low teens, upper 10, low teens area to make sure that we're basing the deal off cash flows and not just appreciation. Okay. Is the IRR, the internal rate of return, at 16 to 19% or greater? Okay. In this case, yes. So it does check that box. And then, you know, lastly, and I discussed this, is the property primarily reliant on appreciation or cash flow for the returns for the investors and for the investment group? In this case, it's a blend. The property does cash flow, but we're forcing the appreciation through value add. And that's a key component, especially when you're doing Midwest, Texas, some other states. You need to force that appreciation through value add and not just bank on natural appreciation through rent growth and things you'd see kind of on the coastal markets where you get that push naturally through appreciation. You got to force it in certain markets in the middle of the country. So that's what we're doing in this case. So just like flipping a house, we're flipping an apartment building, just on a much bigger scale with more zeros. So we're not relying on the natural appreciation in this case. We are focusing on the cash flows, which is good, and that does check that box. So overall, if we could find ways to push the rents, which would help the exit value, okay, if we could do that beyond what we're anticipating here, then it would make some more sense. Or if we could purchase the property around 18 million, which I don't think is going to happen anyways, because I don't even think you're going to get it for 20 at the end of the day. So this property is not going to make sense, but I wanted to go through and show you what we look for when we're analyzing it just from straight metrics in the beginning, and then diving deeper into it and doing this full-blown analysis on a property to see if it's going to make sense to be able to provide ourselves as well as our investment partners the confidence that we're going to be able to get a deal, and a good deal that's going to grow wealth for everybody, both short-term and long-term. So I hope that helps. Hope you enjoyed it. If you have any questions, click the links below to get the full pitch decks and information. You can click on anything below and go to some of the websites. Love to be a resource for you if you're looking to do anything investing. You know, if you just want info, love to be here for you. So until next time, have a great day.